Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison Mills alongside Julie Hyman. Let's get you the three things that you need to know today.
First up, U.S. stock futures are falling this morning as investors kick off second quarter trading with tariff headwinds front and center. The start of the second quarter coming after a volatile start to the year for the markets. The tech-heavy NASDAQ 100 down 8% in its worst quarter since 2022. Meanwhile, the Magnificent Seven group extended its quarterly rout to 16% amid lingering concerns about an AI bubble. And for the first time since the onset of the pandemic in March of 2020, bonds rose and stocks fell in a 3-month period.
And President Trump settling in on his tariff plans, but saying he won't reveal them yet. According to reports, Trump's team has pitched him on several ideas of how to tariff other countries, including a 20% global tariff on virtually all imports. Meantime, the European Union is preparing to retaliate against the U.S. if the president imposes reciprocal tariffs on the bloc. EU Chief Ursula von der Leyen saying the EU has a, quote, strong plan to hit back if needed.
And we'll get a fresh read on the health of the economy this morning with job openings data and the latest ISM manufacturing survey. The manufacturing sector may show renewed weakness once tariff front-running is done. Meanwhile, job openings likely ticked up in February, a sign that labor demand is holding steady.
Stock futures falling this morning as investors await President Trump's April 2nd tariff announcement, which continues to weigh on markets as investors kick off second quarter trading with headwinds looming. Joining us now for more, Michael O'Rourke, Jones Trading Chief Market Strategist. Michael, great to have you here. Stocks had a tiny bit of a rebound. Obviously, we're seeing some more selling this morning. Where do we go from here? Have we hit any semblance of a bottom, or is this just the beginning of potentially more pain?
I think it's probably the beginning of some more pain here. We've had a nice correction in the market, but as you know, there's a couple of negative catalysts out there that when you combine them, the market probably should wind up moving lower over the intermediate term. Obviously, we have the tariff uncertainty, and we'll get a little more clarity tomorrow, but we're not sure it's the type of clarity we want to receive. And then, as you mentioned earlier, AI stocks are coming under pressure, and they've been a big upside catalyst for the market for the past 2 years. And we have to see how that, that group how their business plays out, during earnings season and in the next few months.
Michael, one of the big questions we've been trying to figure out is what is priced into this market. So some of the reports today are saying we could end up getting a 20% universal tariff announced tomorrow, although we don't yet know exactly what's going to be announced. But has the market priced in a scenario like a 20% universal tariff?
I don't think it has. As you can see, the market reaction after the auto tariffs were announced. While we knew auto tariffs are coming, the market was still somewhat surprised. I think a 20% number on everything that's imported into this country is a massive number. And it's part of the president's larger plan. And we also don't know what the retaliations are going to be. So it's really hard to game plan how this is going to play out for earnings, how it's going to play out for the economy, how it's going to play out for companies. So that in combination with the weakness we've seen in the AI sector, which has been the catalyst for the market on the upside the past couple of years, it means there's still a lot of risk out there that's yet to be, priced into share prices.
And Treasury Secretary Scott Bessent was talking about some sweeteners to come following tariffs in an interview on Fox News. He talked about tax refund for automobile purchases, for example, and also no tax on tips and some of those sweeteners. Are those sweeteners enough to be bullish for the market after some of the pain driven by tariff policy?
I don't think they are, just in the sense of you have to actually get those funds. The government or customs has to collect those funds, and they have to go to Treasury before you can start handing money out. And ideally, you want to be in a situation where you're not, taking from one, collecting money one way and giving it out another way. The whole idea is to get the deficit in order. The whole idea is to open trade up. I mean, the best case scenario in my opinion, for the administration is that when one or two countries come out and say they're going to drop their tariffs, which is what the president has talked about, like what he'd like to see, all of a sudden, if that starts a trend, then you're opening up trade, and then you're opening up, economic growth opens up, and you're moving in a positive direction. So right now, as the two sides go back and forth and are going to spar over, what tariffs going to be and who's going to retaliate and how, it just creates a lot of friction in the near term that, we can get those sweeteners later, but until you collect that money, we really don't know what they're going to be.
And to your point earlier as well, market recovery is going to be difficult to achieve without a recovery in the mega cap tech names. A lot of people really relying on those for their portfolios, given the weighting on the indexes here. Do you envision us ever getting back to a 30x multiple on the Magnificent Seven, given the year-to-date performance we've seen in some of these names?
I think you're going to see more multiple compression in that group. Obviously, the excitement around that group has been that they're going to be leaders in the AI space, the massive investment they've made in the space. But there is the risk that, you start to see disruption. There's concern for Google shareholders that ChatGPT's, garnering search business and things like that. So you're seeing more competition, pick up. You're seeing the likes of Broadcom, Marvell, and Amazon starting to compete with NVIDIA. So I think, again, there's more, there's no clue, it was pretty clear who the winners were the past 2 years. It looks like there's going to be more competition going forward. So I think it's another situation where investors need to wait to see how the environment evolves for AI.
Mike, I want to ask you about trading vibes through a particular lens. Even as we see all of this choppiness from the macro, we see individual examples of things like Newsmax, which came public yesterday and surged by 735%. It's up another 44% this morning. Does it show that sort of the meme stock appetite is alive and well? And if it is, what does that tell us about sort of the bigger markets right now?
I think it does say that meme appetite is alive and well. I mean, it is interesting. Of course, CoreWeave was supposed to be the big IPO of the year, and that disappointed on Friday. And then Newsmax was more of a sleeper, a small deal, and of course it has a small float. So it's been, it's gone straight up since it opened trading yesterday. But things like, these companies selling shares to buy Bitcoin. There's still a lot of excess liquidity in the tape. So again, it just shows we probably have not priced in the risks associated with, the economy and tariffs. And if we do see a larger AI unwind. So there's still, I would say there's still a fair bit of risk out there.
Mike, thank you so much. Good to see you.
Thank you.
President Trump will unveil his long-awaited reciprocal tariffs at a ceremony Wednesday in the White House Rose Garden. That announcement due at 3 p.m., according to Treasury Secretary Scott Bessent. There are a few details around the planned rollout, but Press Secretary Caroline Leavitt said there were no exemptions, despite calls from both sides of the aisle to spare certain goods. Joining us now to discuss, E.J. Dionne Jr., Senior Fellow in Governance Studies at the Brookings Institution. E.J., it's good to see you. So as we sort of go back and forth here about tariffs, there does seem to be this interesting divide between the White House, the president and the White House, and this pushing ahead on tariff policy, and almost everyone else, from market participants to the public, who feel at the very least uneasy about the path this is taking. What are the sort of political risks in pushing ahead with this, and how is that going to play out?
With you, and you're exactly right. Even people who are not pure free traders and think tariffs can be appropriate are amazed by the way Trump has done it, by the erratic nature of it, and a sense that this very, very broad tariff is not the way to go. Today's Financial Times, the print edition, on the same page, as Liberation Day approaches, people are anxious and concerned, not excited. Down the bottom of the page, Mexico's economy could slip into recession. That's not good for us. Over to the side of the page, same page, the EU may impose duties on services, which is, of course, is a great strength of the American economy. It's funny with President Trump, we often say, and I think it's true, that he'll adjust his positions on issues for political reasons. Abortion is a good example. But on tariffs, he really, really, really seems to have this notion that broad tariffs can revolutionize the American economy. And I think one of the things he said that's going to bother not only markets, but a lot of voters is he said yesterday that people will be able to tolerate some pain. He didn't promise any pain in the last campaign. He promised the prices would go down. And that is not what tariffs tend to do, to be charitable about it.
Well, and I wonder from your perspective then, EJ, is there any degree of pushback from constituents who were promised lower prices, from lawmakers, from members of his cabinet, from executives that would move the needle on tariffs? Or is it your interpretation that this is a policy point that he is going to be sticky with throughout, regardless of any pain?
My reading of, you never can predict President Trump with full accuracy, but this is something he really profoundly seems to believe in. He loves to talk about President McKinley's economy. That was way back in 1900. I think he will get pushback from many of his business supporters. I think he'll get quiet pushback from some Republicans in Congress. And he's talking about making it a little easier, subsidies with farmers and the like. But of course, that is a kind of robbing Peter to pay Paul policy. Well, we'll spend government money to subsidize farmers. You're going to get a test today in a couple of congressional races in Florida and in that big Supreme Court race in Wisconsin, where Elon Musk has put in a lot of money to support the conservative candidate. Tariffs will only be part of the issue. But I think, for example, if the Democrats win in Wisconsin and make gains in these two very Republican seats, even if they don't win them, that's going to be a signal that what President Trump is doing is not as popular as Republicans would like it to be. And I think that may open up the space for a little more pushback.
I'm curious, EJ, if Democrats do gain ground in those races you're talking about, will it be because they've sort of blundered into it and are, basically benefiting from Trump's mistakes? Or are they strategically doing anything right? I mean, I'm thinking of Cory Booker, the senator who's did a sort of all-night speaking session. He was still talking as of an hour ago, sort of a protest speech about President Trump's policies. Is that what they should be? Is that what the Democrats should be doing?
I think there's a real difference between Democrats in Washington who continue to argue about strategy, although I think what Booker did was extremely well timed and I think reflects where they're going, versus what's happening in the grassroots. The grassroots of the party are enormously mobilized. If you look at what's happened in Wisconsin, what happened in a special election last week in Pennsylvania, where a Democrat won a state Senate seat in a district that went for Trump by 15 points. Democrats on the ground are sending a message saying, look, whatever power you have, use it, because we are petrified about what's happening. And so I think what you're going to see, which happens a lot in politics, is what's happening on the ground will bubble up to the leadership. And as I say, I think what Booker did is reflective of where Democrats are going to go. I think they're going to get tougher and tougher on Trump.
All right, EJ, we got to leave it there. Thank you so much for joining us. Appreciate it.
Great to be with you.
Coming up here on Morning Brief, we're going to count you down to the opening bell on Wall Street as Wall Street kicks off its second quarter. Plus, we got Tesla seeing more sales woes in Europe as one analyst warns of a coming decline in earnings. Details for you next. Also, automakers overall imploring the president to make exceptions on his tariffs. We'll break down the outlook for the industry and much more ahead on Morning Brief. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. This morning we are watching Tesla, PVH, and Johnson & Johnson. First up, Tesla sales falling 37% in France last month as the automaker faces a slowdown across Europe. Tesla delivered just over 3,100 vehicles in France in February. Tesla sales have slowed across the continent due to several factors, among them a changeover to the new Model Y, as well as protests over CEO Elon Musk's role in President Trump's administration and his political leanings in Europe overall. Now, a fire at a Tesla dealership in Rome on Monday destroyed 17 cars and is currently under investigation. Just one of the many headwinds Tesla is facing right now. I do want to also point out that we have a note from Wells Fargo this morning. The analyst over there seeing little immediate levers to pull to increase volumes, talking about earnings declines coming for Tesla, saying the company is going to need magic moving forward to be able to persist, talking about the EV credit pullback being a headwind and also just disappointing fundamentals overall.
Right. So Tesla is now still down, 40+% since its record highs where it was late last year. I think its actual record high might have been election day, if I'm not mistaken, or thereabouts. And so, we've had a lot of folks come out and say that as long as Elon Musk is doging, then there's not going to be a recovery for Tesla, and that's borne out in the action. Yeah,
it certainly is, and you continue to see that pressure. Though today, the stock is moving to the upside.
Yeah, so. I mean, the other thing to consider is that there are a lot of Tesla apologists who have said that once the new Model Y comes out, that will spur a sales boost, that's part of the reason why the sales have been down so much. So we'll find out when we get the numbers.
We certainly will.
And just to mention as well, this is a day, today and tomorrow, when we start to get the sales numbers and deliveries numbers from the automakers.
Yep.
Ford just came out with its numbers in the last few moments here. In March, its retail sales were up 19%. And obviously, one of the questions we're going to be asking, along with all the other cross currents for this month, is whether people were, if you were weighing an auto purchase and you know that auto tariffs are going to be imposed, do you then rush that purchase?
Totally.
So that'll be interesting to see if that flows through to the numbers. So Ford U.S. March retail sales up 19%. First quarter U.S. retail sales up 5%, although total sales in its first quarter down 1%. So obviously seeing strength in the U.S. accounting for that.
I guess one of the only times that a huge jump in sales could potentially be seen as negative news, just because we don't know if there will be a huge drop-off moving forward off the back of that in the quarters to come here.
Yeah. All right, next, shares of Calvin Klein and Tommy Hilfiger parent PVH popping double digits in pre-market trading. That's after an earnings beat and a forecast for flat to slightly positive sales for 2025 came in above expectations. CEO Stefan Larsson citing a tough consumer backdrop in North America, though, behind slowing sales in February. PVH was also blacklisted from China in February after an investigation last year into whether the company was boycotting certain types of Chinese cotton. But it looks like a lot of relief being expressed here about that forecast, especially since the shares were down something like 39% this year going into this report, which came after the close yesterday.
I thought it was really interesting, too, hearing a little bit more from the CEO about the consumer backdrop here, talking about how there is both a tough backdrop in China because of the consumer backdrop, but also because of some of the legal challenges they're having over there that you mentioned, Julie, but also saying there's a tough consumer backdrop in the U.S. And I just thought it was interesting to hear him mention those two in the same sentence, because we've been talking about the recessionary pressures in China for consumers, at least for so many years, and now to hear the U.S. lumped into that same sentence feels like potentially a tough backdrop here. Also, I wondered if the degree of the pop we saw in shares was investors kind of clinging to any company that has strong forward guidance in the consumer space amid such an uncertain environment.
Yeah, I was checking on short interest for it too, because I thought maybe that was something fueling it. But the short interest, it's not, I mean, it's about 5.6% of float, according to Bloomberg, which is not crazy. So maybe there's a little bit of short squeeze effect, but it doesn't seem to be that pronounced here.
Really smart to check that. Great point.
It's one of my go-tos.
Something to keep in mind.
Thank you.
Very great. All right. Well, finally, we are also going to talk about shares of Johnson & Johnson taking a hit after a bankruptcy judge did dismiss the company's third attempt to resolve personal injury cases linking use of its talcum powder to cancer cases. Here with more on what this means for J&J, we've got Yahoo Finance's Anjali Kamlani. Anjali, Third time still did not work out for J&J, at least.
Third time, not a charm for them. That is absolutely correct. And this is after changing not just the venue, but also the subsidiary that they were fighting this under. So what we saw was J&J basically take a hit, as you can see, down a little bit close to 3% this morning. Not too much, considering that this is, putting them back on an uncertainty path with what to do with this case. So at stake is about $8 to $10 billion in that settlement. J&J saying they're going to reverse about $7 billion that was set aside for this case back into the company's coffers. This whole case, the total of the settlement, isn't too much of a hit financially for the company. It represents about 2% of the company's market cap, and so that's why the company isn't really, taking this maybe with too much of a hit there. It's important to note that at the core of this rejection this time, and previously in the New Jersey cases, the judge had said that bankruptcy wasn't the right path for the company because it wasn't in danger of actually being bankrupt, and so it was inappropriate to use that route. Here now, at the core of this argument, is that the company achieved the necessary percentage of claimants in order to reach a settlement unfairly. So they needed about 75%. J&J said they have 83%, and the judge said, well, it's questionable how you got to that 83%, and about half the cases don't really qualify. So that's where we saw the need for that rejection. Now, we've seen some notes from analysts talking about how this is really this is really not that big a deal for the company, but it does put them back on a path to uncertainty, as you can see on your screen. So based on the judge saying that this is generally referred to as an improper voting process, that's what the company has to try and resolve. The company did say it is going to go back into the tort system. They said in a statement today, quote, "We prevailed in 16 of 17 ovarian cases tried in the last 11 years and will devote our efforts to defeating the fake claims." The company has been pretty vocal about the idea that some of these claims aren't even valid. So that is where they're going back on it.
Interesting. So there's still more to come.
More to come. This is not the end of the story.
Doesn't sound like it. All right. Thank you, Anj. Appreciate it. Well, as we head to break, let's get a check on shares of Newsmax. Now, remember yesterday, the company had its public debut, and the shares jumped 735%. Yes, it's one of the best performances ever for an IPO, and it's climbing again today by more than 40%. The conservative media outlet's initial public offering was helped by individual investors, handing the IPO the best first-day performance for a public offering since 2022. The company was among the 25 most actively traded on Fidelity's platform, one of the most popular brokerages, of course, and the trading gave the company a market value of $10.7 billion. The surge that we are seeing is the largest since Adentax Group stock leapt more than 13,000% in a single day. By the way, IPOs that have these kinds of first-day pops, it doesn't always work out well in the long run, so we'll keep an eye on it. More ahead, our morning brief. That's the opening bell. Let's do a check on the markets here. And this week, obviously, there's been a lot of trepidation in the markets, a lot of nervousness about what's going to happen tomorrow with the tariff announcement, a lot of reporting going in different directions this morning. President Trump last night saying he's decided on his tariff plan, but he hasn't shared that with the rest of us. And there are reports that he has been presented with a plan of 20% universal tariffs, but that he's been presented with other plans as well. So it's unclear what's going to happen. The market, though, is selling first and asking questions later. At least for now, we could see things change as the session goes on, obviously. But right now, the Dow opening lower by nearly 160 points here, about 0.4%. The S&P 500 down in percentage terms about the same amount, off almost 0.4%, about 21 points. And the NASDAQ, like we saw yesterday, leading the declines here as we are seeing when there is a risk-off day that it tends to be hitting large cap tech the most. And so the NASDAQ as well, down 0.4%. Our Jared Blickery has got a look at what's under the surface here and what's moving. Hey, Jared.
Thank you, Julie. I like your comments about large caps versus small caps because that has been the story of the year. The large caps, especially the mega caps, have been silent. And let's just take a look at some of the charts here. We got the NASDAQ heading for its 5th straight loss, but meanwhile, not all the indexes are looking that bad. And I want to show the year-to-date price action in the NASDAQ. A little hard to see these candlesticks, but yesterday we dipped. We opened far below the previous low there. You can see this is uncharted territory for the year that I'm circling. Then we closed just underneath those lows. But you take a look at the S&P 500, and it was playing a joke on the bears yesterday. Got a little bit of a bear trap there, started out going down, but then it reversed course, and all of those new shorts got turned into new longs here. So S&P 500 looking pretty strong here. And then meanwhile, small caps, which haven't been doing too bad this year, those are heading for a 5th straight down day. I also want to highlight the different action that we're seeing in the 10-year T-note yield versus the dollar. They used to go up, at least in this bull market going back several years, they used to go up and down most days together. Now most days they are moving in opposite directions. Today the direction is down for the 10-year T-note yield. That's down 7 basis points to a 4-week low. And you can see getting into some interesting territory down here. And then you have the US dollar index, which is heading up. And not in a big way, but it's notable because this is a pattern that has been persistent over the last few weeks, if not months, and we've seen it playing out throughout the market. Today in sector land, we only have a couple in the green and just barely real estate and consumer discretionary. To the downside, healthcare leading, and we were just talking with Anjali about some developments there. But tech is coming off its longest monthly down streak since 2018. That would be 4 months. And I'll show you a quick chart of tech this year. It looks a lot like the NASDAQ 100 that I was just showing you there. Here's that second day just punching below those recent highs. And let's take a look at some of the Mag 7 that we see in the NASDAQ 100. Tesla leading the Mag 7, well, among the Mag 7, I should say, Tesla is the leader. Most of these going the wrong way, but Tesla's up 3%, Pinduoduo up 2%, but not seeing a lot of outperformers here. And I think we'll head over to futures land. Futures is where we're seeing gold at another record high. So I'll get GC equals F. It's up 0.4%. And I believe it punched into the 3170s here. You can see it's at 3162.70 right now. Up 19% for the year. Over the last year, up 41%. And that is just a nice, strong looking bull market right there. And I will close on Bitcoin. Haven't really talked about it recently because the price action has been pretty muted, although we are seeing it up 2.25% today. I'll show you the year-to-date chart in lines, and you can see we're underwater here, but we've just been in this holding pattern. And importantly, we got the 200-day moving average kind of sloping down there. You don't want to see Bitcoin fall below that, but as long as it's not doing anything, it's just coiling for a larger move. And in the meantime, we just sit on our hands, Maddie.
All right, Jared, lots of hand sitting at the moment, waiting for certainty. Thank you so much. Appreciate it. It's time now for today's strategies session. Stocks kicking off the second quarter in the red. For investors hoping that the worst of the selling may be behind us, don't hold your breath. The same headwinds that led to the S&P's worst quarter in 3 years haven't gone away, almost 3 years. Joining us now, we've got Yahoo Finance markets reporter Josh Schaefer. So sorry about that, Josh. The headwinds are still here, and that's why I know some of your sources say they're not dipped by.
So essentially what I was thinking about, Maddie, as I was writing this story was sort of hearkening back to something that Julie actually talked to Rick Reeder from BlackRock about last week. He said the market sort of gets fixated on one thing at a time, right? And we can't focus on more than one thing, really, it seems like, in these moments. And right now it's tariffs, right? And so you have the tariff deadline, so to speak, maybe, coming on Wednesday. And it kind of got me thinking, okay, so what if we actually did resolve the tariff number question, and we get a tariff number, market can start work at pricing that in. What else has actually been going on? And there's just a lot of other things that have not been trending that well over the last month during this sell-off, right? So I'm thinking about the consumer vibes we've talked a lot about, sort of sentiment, right? Consumer sentiment, investor sentiment, overall business sentiment has not been doing well. Yes, that's partially tariff-driven, but there are other factors at play there too. You think about the weakening economic data that we've seen through the first quarter. You look at something like the Citi Economic Surprise Index, which tracks how economic data comes in versus expectations, basically been a straight line lower through the first quarter, right? We're starting to maybe catch back up to zero there. Maybe we finally brought those expectations far enough down. But I think of things like that, you think of the earnings cuts we've started to see. Again, not all of this is tariff related. The consumer spending that you saw drop in January and February. And so the question is, all right, we've removed the maybe at some point, the constant tariff headline, constant tariff talk. How are things actually going? And I don't know if they're going that great anyway to give me some reason to feel like, all right, there's conviction once the tariff uncertainty is over that everyone should be buying.
Well, and we also have an event pretty immediately after the tariffs in the form of Jobs Day on Friday. And it's been interesting to hear, like we talked to Aditya Bave from Bank of America yesterday, economist there, and he basically said it's all about the labor market. And he is not as worried because of what he perceives as the relative solidity of the labor market. But if that goes, all bets are off.
It feels like the last thing that people are sort of staking their claim in right now, right? In terms of economic data, you can hear a lot of economists talk about risks of recession are rising, a lot of things don't look great, but at least we have the labor market.
Yes.
At least layoffs are low right now. And we've sort of been on this thin line of, all right, we have to teeter one way at some point. And I do think you raise a good point, Julie, of what if the unemployment rate starts creeping up? Mm-hmm. And not necessarily that in and of itself is ultimate panic moment, but you add in the slowing economic data narrative with perhaps maybe a slight slip in the unemployment rate. You have a hiring rate that's at basically a 10-year low, right? So these people that would go back into the labor market, how are they going to find jobs? And so you have a lot of dynamics at play that don't set up for a welcome environment for basically any downside to the labor market at this point, which feels, I don't know, not great necessarily.
Definitely not great. Well, and I remember Victoria Fernandez, I think, telling us that the tariff impact could have a 9-month lag time for when we start to see it impacting layoffs, because if it hits profit margins in a certain quarter, maybe up to 9 months later, we could see companies cutting costs through their labor versus any type of other way that they could kind of increase their revenue to protect their profit
There's a lot of
margins.
feed through there, right? And you're not going to really know the answer to that instantly. And then to sort of bring it back to the market and make a stock market point out of this as we end the first quarter, what's going to help big tech at this point? Like, I don't think there's clear catalysts that people are circling other than maybe we finally revised earnings down far enough and like revisions are starting to bounce back. But I thought it was interesting last week, Barclays' Vinu Krishna, he downgraded his S&P 500 target to 5,900, said he still likes big tech medium to long term, but he said for more of a short-term trade in the next quarter or two, couldn't find a catalyst that he really liked, right? And so that doesn't make me feel great about the direction of the major indexes. If your main leaders, people don't see a lot of reasons for people to buy them other than they got a little bit cheaper.
Yeah. All right, Josh. Thank you.
I'll be more positive next time, I promise.
Hey.
No, you don't have to be. don't make promises
I feel
you can't
bearish
keep,
today.
buddy.
It's a bearish
all right.
Tuesday.
All right, coming up, find out which U.S. automaker is best positioned ahead of Thursday's tariffs.
Ford reported its U.S. retail sales surged 19% in March compared to just 5% during the whole first quarter. The uptick comes ahead of planned tariffs on U.S. auto imports later this week that could raise prices by thousands of dollars, according to estimates. Here to discuss what this week's tariffs could mean for the industry, we've got John Murphy. He is B of A's Securities Senior Automotive Analyst. John, thank you so much for being here. When thinking about these Ford retail sales numbers jumping in the month of March, I'm curious, could that potentially be bad news for them moving forward? If this is customers getting ahead of any potential tariffs, could we potentially see a big drop looking ahead? And how are you modeling the impact of that kind of consumer behavior?
So thanks for having me today. We're down to the wire on these tariffs, and everybody is scrambling in their analysis as well as their lobbying in D.C. I think what we saw with the Ford numbers, and we'll see with other numbers as they roll out later today, for March in the first quarter, is that the consumer is a bit freaked out. They're acting somewhat logically and going in and trying to buy the vehicles they may need in the coming months or maybe coming years ahead of these very significant hikes in prices as a result of tariffs. And sort of simply, as we think about this, the vehicles that are being imported, the pricing could rise as much as $10,000 to offset the tariffs. And there's a varying degree of vehicles that are produced here in the U.S., which is about half the sales, are going to need to go up quite substantially as well, because there's reported or proposed tariffs on auto parts. And that's the part of the equation that the industry is lobbying hard for. I generally agree with that you shouldn't have tariffs on certain parts or maybe all parts and vehicles because everybody is hit by that. So if you think about Ford being the best positioned automaker here in the U.S. of the incumbents, traditional players, they're still going to have a heavy tax or tariff burden in their vehicles from those parts. So that is something that their consumers will face, as well as the consumers at Mazda, Nissan, and some other brands that will have sort of huge import tariffs put on them.
Hey, John, it's Julie here. And I have to say your note where you lay out the exposure was invaluable last week in trying to make sense of the impacts of all of this. So that swing of the parts that you're talking about, as you mentioned, reportedly the automakers are lobbying the administration to have the parts be exempted. What is this swing there? You know, for a company like Ford, for example, if the parts get tariffed versus if they don't?
So, Julie, everybody, including us, is crunching these numbers, and we'll hopefully be back sometime very soon with some more detail. The problem is the detail is impossible to figure out because the rules are not set yet. So what we're looking at right now in the initial fact sheet and proposal by the White House is that parts are going to be tariffed. The focus is powertrain and electronics to start. But that may not be the final ruling, and it's by May 3rd that we'll get an answer to this. So we have another month to go to understand what parts are going to be tariffed, how the rules are going to be worked out. But the reality is, assembly in the United States could make sense of vehicles, for vehicles, right? Just based on labor costs, there was not that much of a differential. That would hopefully happen over 5 years, not immediately, because doing that immediately would be damaging. But as far as parts, particularly things like wiring harnesses, other injection moldings, other parts of the vehicle, the labor costs are pretty high relative to the part itself. The reality is there's not enough Americans to make those parts, and those parts probably should never really come back to the United States. Assembly, maybe, but it's very dangerous to raise tariffs on those parts, hurt all automakers across the board, and really drive costs up for American consumers. So I think the lobbying that's going on right now is actually fairly logical and directed in the right direction. Now, when you get to powertrain, there is the argument that you could potentially bring more of that back to the United States. That would be engines and transmissions, but even that is a questionable decision. So we're still all working through this right now.
John, my Roman empire for the morning is this quote from Treasury Secretary Scott Bessent on Fox News saying that there could potentially be a tax write-off for American auto purchases. How are you thinking about that? How are you thinking about the consumer impact of that? And how do you price in these kind of seemingly flippant comments from various members of the Trump administration into your models at this time?
Well, we're taking everything into account that everybody is saying at the moment, and there are varying degrees of disagreements in some of those statements. I think the idea that you would use auto interest expense to the consumer as a deduction for their AGI, so they would pay lower taxes, I think is interesting, but that's peanuts in the equation of what we're talking about right now. It's a good talking point, but it really doesn't change the equation based on what we're talking about right now. I think the real extreme risk here is twofold. One, the 7.6 million units that are being imported to the United States, the manufacturers might decide not to make those vehicles and import them to the U.S., so we might have a whole lot less vehicles available to the American consumer, which actually is pretty bad, as we can all, I think, generally agree. And the second fold is when you talk about these parts tariffs, when you get beyond sort of the known tier ones that we all cover in the public markets, there's a number of tier twos and threes that feed into those tier one components. The reality is some of those parts might just not get made, and we face an extreme risk here in the short term of North American production going to zero for a period of time. That would be a real shock to the system, but it's not impossible based on the way things are being discussed right now. So I think everybody really needs to take a step back, particularly in the auto industry, where I'm axed and could speak as an expert, and take a breath and figure out what is logical here, particularly on the parts side, so that we don't have an extreme disruption where half the industry or the entire industry is taken down.
Yeah, well, I don't know if logic is what is the governing factor here, John. We will find out. Lastly, got to ask you about Tesla, which, as your research showed, what we showed earlier, doesn't really have a large tariff exposure, even though, yes, it imports some parts, but its cars that it sells in the U.S. are made in the U.S. but it's got other issues, shall we say. So I'm curious what your current thinking is on that, especially ahead of getting some delivery numbers from Tesla, and how long you think maybe some of the sales issues there are going to persist.
So it's a great question. This is a company where sentiment matters almost as much as the fundamentals, but fundamentals always matter. And I think what you look at with Tesla is they're going through a massive changeover, their Model Y, both here in the US, Europe, and China. So there's some real disruption that's going on as they're going through a major product changeover. That's about 2/3 of their volumes globally, roughly. So that's been very disruptive to their ability to get vehicles to consumers and sell them. So you have to remember that that's going on. At the same time as an entry-level model, which is supposed to be launched in the first half of the year, we have no specifics or details on yet, so it's unlikely to be launched by June. That product cycle, changeover in the product cycle of new products coming is all important to driving new vehicle sales. And I think if you think about this company as a software and AI company over time, you still need to get the hardware out there to put that software and AI on in the real world. So these product cycles are going to be very important. So I think that's a fundamental challenge for the company here in the short run. The sentiment side is sentiment's pretty bad towards the brands. And obviously there's a lot of political cross currents that are going on here that people I think are conflating a little bit too much with damage to the brand or pressure on the brand. But there's a lot going on here. Sentiment is incredibly negative, and that's often when this stock bottoms out. So we're going to have to keep a close eye on it. We're currently neutral. But it's going to be a messy first quarter for them because of that changeover and some of the sentiment going on. But there's going to be opportunity over time for this to be, probably a pretty solid company over time.
John, thank you so much. Really appreciate it.
Thank you.
We got much more markets action ahead. Stay tuned. You're watching Morning Brief. A lot of the focus around President Trump's policies has been on tariffs, and rightly so. But there are other policies that economists are sounding the alarm on, including pullbacks in research funding. As part of DOGE's efforts to cut costs, the administration has cut or frozen billions in federal grants to researchers at medical centers and other scientific institutions. Our next guest says analysis indicates that for every dollar invested in innovation, we receive at least $5 in social benefits on average. Joining us now, Benjamin Jones, an economist at Northwestern University. Thank you so much for being here. So Benjamin, we've talked a lot about tariffs. We do not talk to many economists who have pointed to those cuts to research funding and the effect it could have on GDP, maybe because it's sort of longer run. How are you looking at that, and how should we be thinking about its effects?
We should think about science and innovation and the American science and innovation system as really the fundamental driver of our long-run prosperity, both in economic terms, our standard of living, but also in terms of our improving health and longevity.
I'm curious, Benjamin, if you can kind of lay out the numbers behind that. I know that you've talked about the degree to which economic prosperity can be driven by an investment in science. Can you give us a little bit more color on that?
Sure. I mean, I think the simplest way to say it is just that, what is it that makes us so much richer and have greater health? I mean, today compared to say 150 years ago, Americans are 18 times richer on average in real terms, and we live 35 years longer on average. So these are incredible improvements in the quality of our life. And what's really the difference between now and 150 years ago, when we had, wagons to travel in and we didn't know about bacterial infection and we had no antibiotics? It's not that we just did more of what we knew how to do back then. It's that we keep coming up with new and better ways of doing things. That is what makes us richer. That's what makes us live longer, new and better ways of doing things. And where does that come from? It comes from science. It comes from corporate invention. It comes from entrepreneurship. It comes from people who are trying to try new things, new understandings, and from them, new products, new services, new treatments in a medical context that make our lives so much better.
I think this administration wouldn't disagree with anything you're saying. They would just say it shouldn't be funded by the federal government, that they want this transition to where it's going to be funded by the private sector. Do we have models for that? Are there other countries where you see this robust pipeline that is privately funded? Can that exist in your view?
Well, first of all, the U.S. science and innovation system is world leading, and our economy is world leading. Those things are connected. We lead at the frontier because we are the best at this. And so why would we want to change it is already a risky proposition to change something that's working so well and has worked so well for us for so long. Why federal funding? Fundamentally with science and invention, but fundamentally mostly with science, the market returned to a new scientific idea, say a new understanding of nature, say Einstein's equations of general relativity, or the Human Genome Project, knowing what genes are in your body and what they look like. The market returned immediately to say a new understanding of a gene or a new cause of disease, an understanding of what causes a disease. There's no market return to that understanding. The market's not going to produce investment to figure out necessarily what the source of a problem is. What science does is it figures out what is going on and improves our understanding. And then from that, the market can generate new products and services to try to tackle those problems. If we turn off the science, we turn off this kind of fundamental upstream input into our ability to move forward.
All right, Benjamin, we got to leave it there. Thank you so much. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst, and then Julie for Wealth. Stick around.